Good morning, everybody. Quick, let me know if you can hear my voice and see my screens. Do you see the black and blue on the right side of your screen and the white charts on your left? There we go. Sweet. Fantastical. Well, I'm going to break this week's session up into 4 lessons. Today, we're going to cover the first lesson. Tomorrow, we're going to cover the second and third lesson. And then Thursday, we'll cover the fourth lesson together. And by the end of Thursday, you guys are going to have a book from me that goes over all these things as well as the recordings for it. There are 4 stages of learning that I've gone through as it applies to timing signals. And today we're going to talk about stage 1. And stage 1 to stage 4 involves a progression of understanding about time as it relates to market price action and the codes, patterns, principles that drive the time signals. And we're going to move from a very simple base level understanding of the time signals and ways we can operate with them, all the way through what I perceive to be sort of where I'm at right now and a few others are, a total comprehensive understanding of the time signals and almost a freestyle approach to time. When we're talking about stage 1, we're looking at users who are in the 4 to 8 week range. These are customers that have had the software anywhere from day 1 to day 30 to day 60. And in essence, we're talking about signals and patterns number 1 and patterns number 2. There's no room in the Parthenon of analyses for the other patterns, which will begin to emerge for patterns 5, pattern 6 and 7, pattern 8 and 9 in stage 2. They are completely outside of the realm of possibility of RevPol, this idea of a sequence of inverted patterns, 4, 5, 6, 7, 8, and 9. And so when we're looking at time signals for the very first time, no pun intended, we don't know that some of them can go backwards. We don't know that they can go backwards in a sequence, one after the other after the other. And we certainly don't know when that sequence of backwards patterns is coming, what the structure of that pattern will be. We don't know how to split time sequences into thirds. We're just looking at white and blue dots. And over the course of a market, we will generally see price action that has the buying times on the bottom, pattern number 1, and the selling times on the top. This is ideal in an uptrend and what we're expecting to see when we get to a time that is a buy signal and a sell signal in an uptrend. And so we're going to live inside of this space today as we watch the signals, and we're going to be studying signals with trend, the crossover variation of a signal with trend. We're going to be studying punctures, as well. Well, okay, interesting. Punctures, as well as aggressive counter trend trades, as well as CDOSs closed in the direction of the signal. It's interesting how it just makes this weird box. Anyway, so tomorrow we're going to cover number 2 and 3. And then on Thursday, we're going to cover number 4. When we're looking at number 1, we need to understand what we should expect at patterns 1 and 2, depending on what the market is doing. For example, in an uptrend, let's pick a better color for that. In an uptrend, we're anticipating structure to do this thing that I want to point out. At the buying times in a trend, we're expecting price to rise higher. So if we arrive at a time that is a white dot or a green dot, however you've colored it, a buying time, a pattern 1 on your histogram, in an uptrend, these are places we're expecting them to go higher. That seems pretty obvious. In an uptrend, though, when we get to the sell signals, we're expecting one of two things. In an uptrend, we're either expecting a pivot to come in where the market reaches a high and then starts to drop down, or we're expecting a reaccumulation phase. So many times in a webinar or in a demonstration, someone will say, Michael, it did not go down at the red dot. It went sideways or even kept going higher. And to answer that, we need to understand what these times represent. In an uptrend, when we're looking at sell times, we're, especially with Warp or Chronos, we're arriving at a moment where historically people have sold enough contracts, enough shares that the market has put in a pivot. It's a time where people have sold. So when they sell in relation to the direction of the flow is critical in understanding what to expect. So when we're looking at this market and people have purchased here and we arrive at a selling behavior time in an uptrend, there's a very good chance that we arrive at a reaccumulation phase. And what happens is people are taking profit right now and they're selling into this high of a range. People are also not wanting to miss out on the next move up, and they're buying at the bottom of this range. Richard Wyckoff, the father of modern volume analysis, talks about this pattern and calls it a reaccumulation pattern. People are getting onto the train at the train stop. People are getting off the bus in Albuquerque and getting on the bus in Albuquerque and heading to Phoenix. There is a range of people as opposed to a pullback in the prior example. And so this presents two opportunities for us in relation to how we treat counter trend signals in an uptrend. And we'll talk about that in a second. What we're really focused on, if we're trend traders, are the times that are aligning with the trend. And so these are the areas where we can and stand to make the most amount of money in a trend environment. We're looking at the span of time in between the buying signal and the selling signal. We have this shelf life of if the people show up to buy like they have historically, then this entire window of time exists until historically that pivot has formed. This is an estimate of how long the milk has to sit in the refrigerator before it potentially spoils. And so all sorts of opportunities open up for us in relation to a trend signal. And this is one of the first things we learn in weeks 1 through 4, 1 through 8. And we affectionately refer to these as SWTs or signals with trend, right? And I'm not absolutely gifted with these drawing tools yet. However, there we go. These are signals where we see that the market is moving higher, either structurally, higher highs and higher lows. We see that the market is moving higher, in our case, evaluating a trend line. And in my class, you'll see that I use a 120 period EMA and or a 20 period EMA. Personally, when no one's looking, I tend to steer towards the 20 as it has less lag, but you can use whatever you want. For example, you can use a VWAP. You can use a volume weighted average price. You can use a Bollinger Band. You can use a Keltner channel. You can use any one of a myriad of things to help ascertain what direction is the trend going. But it should be something quantifiable, something that if 100 out of 100 people look at it, they all say, yes, this tool is saying uptrend. Yes, this tool is saying downtrend. If you're using a tool to identify the trend that isn't unanimously observable to be up or down, you should avoid that thing because now discretion comes into the play. So when we arrive at these signals with trend, there are two opportunities. I follow the second in the class together with you guys. The first one, we have the close of the buying candle gapped by a 1.5 ATR stop. So from the close of the buying signal candle to the dot line, in the software, we have a 1.5 ATR stop. There's one market where I advise having it smaller for everything, and then 1.0 for the NQ. Or I'll put an asterisk, any volatile, highly volatile market that is known to sweep in large movements up or down, a 1 ATR value, average true range, is about as small as we can go without asking for market noise to destroy our positions. And so the nice part about the average true range value as a stop is that as the market volatility increases, the ATR stop increases, but our potential for reward increases. As the volatility decreases, the ATR value decreases and our possibility of reward decreases. It is an elastic measurement of risk and reward in the market. We should not use a 4-tick stop that might work at 2:30 in the morning Eastern, at 9:35 Eastern. Those conditions are not analogous. So once we have that stop, we're now left wondering, well, what should our target be? Ultimately, in the webinars, you'll see me describe holding on to that position until the very end of the timing window. So possibility one says we hold all the way until the very first reference point where selling has been known over and over again to occur. Okay, so that's option number one. Option number two, the one I follow in the room, says whatever my risk is, I'm going to go for 2-to-1 RR, risk reward. So if I have a $300 risk here, my target is ultimately $600. If I have a $150 risk, my target is $300 worth of risk. So the 2-to-1 method has some earmarks along the way, some touchstones, and I'm going to go over those with you here. If I move in the direction of the trade to the 100% risk mark, that is the area where I go to break even. If I move to 150% of what I was willing to risk in the trade, I will then move my trail stop to 100% of my risk. That is to say, if I had to risk $200 and it gets to $300 in my favor, I will have gone to break even and then locked in $200 of profit. When it gets to 150%, I move my trail stop to lock in 100%. When it gets to 200%, I'm going to exit. Now, anywhere in between 150 and 200% is a place where discretion can exist. And you've heard me refer to this in the room when it's my turn. I call it the no judgment zone. Anywhere from 150 to 200. If you see something squirrely that's making you uncomfortable, if you're seeing the market stop and stall at 180% of the move, it's going up to your target and missing it by a few ticks, close it. The no judgment zone is anywhere from 150 to 200%. And this puts in a permissible element of humanity back into your trading. If your risk reward ratio is 1.5 to 2.0 over time as a trend trader, you will make more money than you lose, provided, of course, your win rate isn't ridiculous. In a trend environment, the win rate that we're looking for is somewhere between 50 and 60%. If you have a 60% win rate with a 2.0 profit factor, you are Lord of the universe. One of the partners in the Turtle Trader saga had a 5% win rate for what it's worth. And the other 95% of his trades were losers. The 5% that were winners were monsters, but he held them forever. So signals with trend, we have a 1.5 to 1 ATR stop. We can hold it all the way until the close of the next signal, or we can hold it to our 100, 150, 200% levels. The other mitigating factor is if for some reason it doesn't hit our stop and closes below the moving average. If it does not hit our stop, let's say our dot line is down here somewhere, and it closes below our moving average, we exit with a loss. If it closes below or above in the other direction, it cancels out the trade. That's a signal with trend. Now, when we get to the top, we don't want to use the full big boy stop, big girl stop. This 1.5 to 1 ATR stop is here for trend trading. And so what we've noticed with the time signals is somewhere around 25% of the time, these time signals are the exact high within a very small distance of an exact pivot, both above and below. And so what we're looking for are ways to mitigate our risk when we get there. So the first thing we're going to do when we see a counter trend signal is look to the left and see if there's any structure that supports a stop that's less risky than the trend stop. So for example, if you're coming up and you have some movement like this, and then we arrive, the candle closes here and there's a sell dot. Your sell dot risk is all the way up here. We see that there's structure to the left that's less than that. That's the structure we'll use. So if you have structure to the left of your counter trend signal that is less than the ATR stop, that's what we want to refer to. If you have a signal that is all by itself, and you have your sell signal here and that candle closes and there's a tiny wick, that is the stop we're going to use, the absolute smallest risk possible. So when we have an aggressive counter trend trade, we're going to look left for structure. If no obvious structure exists, we're going to reference the high or the low of the candle itself to get in. Generally, I'm looking for a 1-to-1 RR, a 1-to-1 risk-reward ratio on aggressive counter trend trades, 1-to-1. Now, if your risk on the trade is 2 ticks, if it's a very small amount where it's tiny, tiny scalp, I don't know yet what to extend that target to. There's an element of discretion there. I'll generally hold it until I get some median value, some remedial value, like a $200 move in the ES or the NQ. But if the risk is $20, it's almost not worth playing unless you're a scalper and that's what you do. So aggressive counter trend trades, 1-to-1 RR, I can go to break even when the trade moves halfway. At 50%, we can go to break even on an aggressive counter trend trade. So I can hold it all the way to the next signal, option 1. I can hold it all the way to the next signal, option 1. I can reference structure and get a 1-to-1 RR, risk reward ratio, moving to break even halfway. Or I can go for a nominal amount if the risk is next to nothing and I'm trying to pull money out. Aggressive counter trend trade. The third variation, what we referred to as the puncture, involves an understanding of what's happening when we get to these selling points in a hard uptrend. If the market is in a strong uptrend, there's great news, everything looks good, there is a fever to the upside. Eventually, the selling is just going to break down. The selling is going to finish. There will be a stampede of people who want to get in when this thing slows down long enough for them to run up to the train and grab it. And so this is where the puncture comes into play. If we have a counter trend signal, there will be a stop line at that 1.0 to 1.5 ATR value away. Before, we were using that as a stop below us in the uptrend or a stop above us in the downtrend. In this instance, we're using it as a means of identifying exhaustion. So if we get to a selling pressure signal and the price continues to rise to the point where it goes entirely through the stop line of the sell signal. All right, let's be very clear. In this example, that's a sell signal. I'll paint it red, it's blue on my other charts. When we go through the stop line, we are buyers as it goes through the stop. This is a mechanical, discretion-free line of no return. We can point to it and say, if we're past the stop line of the sellers, there are probably no more sellers, because we were expecting it to go in the opposite direction. If it's continuing to rise, it means there are so many buyers underneath us that the sellers who normally arrive at this time are incapable of thwarting the upward movement. And so as a trend trader, if there are no more sellers potentially available, we want to be in that number. So my entry is going to be one tick above the stop line of the counter trend signal. One tick above the stop line of the counter trend signal, either above or below the moving average. My stop is going to be 2 ticks underneath the candle which punctured or broke through the line. So the candle that is running through that tape, pushing past that barrier, I'm referencing the structure of that candle to say, here's my risk. Here's where I'm willing to enter. And then I will look for a 100% return on my investment, the same way I look at an aggressive counter trend trade. So if I move halfway to my target, I can go to break even. And now I'm going to exit at 100% of that reward. What if the candle goes through the line and it's a very tiny risk? Let's say it's less than some nominal value like $200. If the candle closes under here, I will reference the structure of the candle to the left. So if the candle before closes $50 under our stop line and then goes through, the risk is less than our minimum amount, I'll reference the candle to the left and put my stop under here. And now my risk reward will be measured from that. So if your risk on the trade is below a nominal amount, in our case, we'll reference $200 for our trading room activities, then we're wanting to reference a nominal value for our risk, in which case we could say 200, or looking for some structure that supports a larger, more acceptable value. But most of the time, the candle that drives through the stop line will be sufficient for us risk-wise. This is called a puncture trade. And so as we're puncturing the stop line of the sell signal, we're acknowledging that whatever back and forth was occurring has finished and the buyers are back in control in our understanding of phase 1 learning with time signals. If you see a puncture at the very basic level, we can hold that trade until the next timing signal. So in a trend environment, the absolute most basic variation of this is buying at a buy signal in an uptrend, holding it until the next sell signal and exiting, waiting for a puncture and holding it until the next buy signal, buying at the buy signal and holding it until the next sell signal, waiting for a puncture and holding it until the next buy signal. That is the most basic way of approaching in a phase 1 environment. Evolving from that, we can deploy risk-reward ratios to allow market volatility to determine where our targets will be and have actionable trailing stops that eliminate a lot of emotion in the trade. You can be up $1,000 in the NQ and watch it go down and hit your stop before it goes to the next red signal. I've seen it millions of times. So having some type of, when it comes here, I do that, when it comes here, I do this, and locking in profit as we go, I have found to be a very good way of ameliorating those fears while we're trading that I'm going to miss out on everything because one rogue candle comes along. Aggressive counter trend trades acknowledges that many of the signals, almost a third of them, are the exact high or low. And so we're referencing structure to see where maybe somebody has stopped on purpose. There's a large amount of supply or demand. We enter without having to use our big trend stop values. And now we are seeing one-to-one risk reward ratios. When we get to punctures, we're acknowledging, hey, this is a time where selling was supposed to occur and it's continuing to go up. In the case of a downtrend, we're seeing buying times pop up, but it's continuing to go down. There's an absence of the side that we're expecting to arrive. And so their absence is permission for us to trade in the direction of the trend at the moment. If we hit the sell stop in an uptrend, we're taking that as free and clear to buy with a one-to-one RR, risk below the puncture candle, or some nominal value if it's less than X. You determine X. For me, it's 200. The absolute final setup here involves, rather, there are two final setups here that are subtleties of these main ones that we're talking about. If we have an aggressive counter trend trade and at some point it closes in the direction of the trade, that's called a crossover signal. So if we have a sell signal, it was an aggressive counter trend trade, it had a $300 risk, one-to-one risk reward, and we hit it, fantastic. It can evolve into a trend signal. So if we have a sell signal here and it closes eventually after our trade or in the middle of it, below the moving average, we now reference the structure of this candle for a 2-to-1 RR trade. This is now in our buying win. This is now in our selling window of time. Our stop goes 2 ticks above the candle. Our entry is the close of the candle. And now we're looking at that 2-to-1 RR that we described for our trend signal. So if we have a crossover, a crossing over of the moving average in the direction of the trend, sell signal closes below the moving average after its initial print, it now becomes a trend trade. If it closes back above the moving average, we exit. If it hits the stop, we exit. 100% break even, 150%, we lock in 100% of risk. Anywhere from 150 to 200% of our risk, we exit. Crossover is a variation of a signal with trend. An aggressive counter trend trade can turn into a crossover trade. Then the final variation in phase 1, and any one of these might be something you enjoy, and you might not like any of these, but this is what I noticed when I was in that first phase of learning. If you have a buy signal and the candle is a low close candle, meaning it was a buy signal, the candle closed low, you don't take it. If the very next candle closes low, you don't take it. If the candle after that closes in the direction of the signal, we call these CDOSes, C-I-D-O-S. So a CDOS is different from everything I've shown you so far. This is a rogue method apart from the other things. And so what we're saying is, hey, if this is a buying time, where are the buyers? When will we know that the seesaw is in our favor and the buyers are outweighing the sellers. How will I know that they've actually shown up to the picnic? The invitation was for 10:05 and it's 10:05 and the sellers are still in control. It's 10:06 and the sellers are still in control. We wait for the very first bare minimum proof that buyers might have been involved by looking for a candle which closes in the direction of the signal, a CDOS. And so now, just like an aggressive counter trend trade, we put our stop underneath the candle which closes in the direction of the signal. Now you can deploy a 1-to-1 RR, a 2-to-1 RR, whatever you want to do. So if you have a buy signal that closes low, you wait, and then when the buyers finally close above, you enter on the close of the candle or your max risk. And now we go off to the races. The selling variation of that, of course, would be, here's a sell signal. The candles are still, let's say, closing higher. And then the next candle closes a little bit higher. And then the next candle closes higher. Then, and only then, when we have something that looks like this, and that candle actually closes at its low, this now becomes a CDOS. Our stop goes above the structure of that candle, and now we're looking at holding until the next signal, or a 1-to-1, 2-to-1 move in our direction. So a CDOS requires a closed candle in the direction of the original time signal. And that is the fourth variation in phase one. So we're looking for, if we're a trend trader, we're looking for a candle that closes after the buy signal in the direction of the trend. Or we're looking for a signal with trend with a 2-to-1 RR as we're moving higher. If we have a sell signal that eventually closes below the moving average before the next buy signal, we try a crossover trade. If the handles are moving higher and higher and we arrive at the stop line of the sell signals, we're trading punctures. When we get to the sell signals, we notice that about a third of them sometimes go down in an uptrend, and so we'll try an aggressive counter trend trade. So if none of those things make sense to you and you want the bare minimum of confirmation, we're waiting for candles that close in the direction of the signal in either of those instances. None of those involve any understanding of patterns 4 and 5. And eventually what you'll start to notice and you'll start to see, and tomorrow we'll get into this, is eventually you'll get to a point where after about the 4 to 6 week mark, you'll start to notice, and we'll go over this more tomorrow. I want to look at signals with you for the rest of the session. You'll start to notice that structurally, the market is going higher and higher, and then you have this candle that has a buy signal underneath it. And around the 6 week mark, 8 week mark, you notice that when you see it, it starts to go down. Or around the 6 to 8 week mark, you'll see the market is falling, and then there'll be a candle that looks like this, and it's all the way at the bottom of this move, and out of nowhere, the market starts to go back up in the opposite direction. In phase 2, and tomorrow we'll get into this, what do we do when we see time signals moving in the exact opposite direction. This happens. It's real. It's part of the Parthenon of timing analysis. It's sort of like knowing when you first started trading, somebody said, hey, have you heard about the 50% retracement? And you were like, no, what's that? And this was all you knew for a while. And then someone comes along and tells you, hey, did you know about the 38% retracement? And you're like, no. And then someone comes along and says, well, you're going to really have your mind blown because there's something called a 61.8% retracement. And you're like, shut up. I thought the 50 was all of it. So right now, today, we're only talking about one element that most people will start out seeing when they first start trading with the timing tools. The most basic thing that you come with a fairly rudimentary understanding of. But there are more levels to this. And eventually, if you stare at things like retracements long enough, you know that there are other relevant levels where exciting things are happening. When we get into the phase 2 analysis tomorrow of learning with time signals, we'll start to see that we can anticipate and actually mechanize our definitions of these points, where a brand new low sell signal is a pattern 4. And we'll have a new thing we can do or augment what we were doing from here on top of that. And then tomorrow we'll talk about how when we're looking for this very mechanical definition of a buy signal arriving at a brand new high, what can we do in those instances to remediate the potential inversion, the potential reversing, absolute reversing of those signals. But in your first 4 to 6 weeks, you don't notice it. You don't know that it's even possible. In the same way you didn't know a 38% fib was possible or a 62, and 50 was all you were looking for. There's an evolution that occurs the longer you use the tools, and I'm hoping to get you to stage 4 by 16 weeks instead of the 16 years that it took me. That's a real thing. Okay. So here we are. We are in the markets now, and I'm going to look at these last 3 signals with you in the Parthenon of possibilities that we were just describing. So live in the background, we had several setups occurring in our stage 1 learning phase with signals with trend, with crossovers possible, aggressive counter trend trades, as well as punctures. And then, side note, CDOS. So in that environment at 916 in the NQ on my chart in NinjaTrader, I have a 1.5 ATR stop. You'll see that under the volatility stop, it's set to 1.5. If I set that to 1.0, the dotted stop line will move closer to the candle. And so now this distance here is closer than it was before. At 916, we have a time that the program is telling us selling behavior has occurred. Selling behavior has occurred here. And so the very first thing I can do is enter on the close of that candle and hold it all the way until 931, in which case I would lose a small amount because we finish a little higher than we started. If I'm using risk reward protocols, I'm putting my stop 1 tick above the blue line. I'm dragging out my architecture here. I never make it to 100%. I can never go to break even. It almost hits the stop and finishes for a small loss. At 931, It is an aggressive counter trend trade. Let's keep note of these. It is an aggressive counter trend trade because there's a good chance it's going to go straight up. So the structure, unfortunately, when I look left, is below the ATR stop of the signal. That dotted white line is here. The structure to the immediate left of me is worse than that. So in this instance, I have to, my voice actually squeaked. The most risk I can deploy is 2 ticks under this candle. So that is stopped out immediately. Aggressive counter trend trade. In the stopping out of that signal, I have the third variation underneath, which is my puncture trade. And we'll come here and I'll use the letter P to denote puncture trade. An aggressive counter trend trade can, and most of the time will, turn into a puncture trade. That candle has a stop right here above the wick. There's the wick, the candle opens, drops down, comes up, continues to puncture that level. My sell stop now is 1 tick under that white line. 1-to-1 RR gets me out of that trade right here. Okay, so if you're keeping track, in, got to get out, -3 ticks. In, got to get out, -3 ticks. Puncture trade all the way to target 1 plus $17. What do we do now? We wait. At 9:37, we have another example of a signal with trend. The moving average is going down. It is blue. Blue, blue. When I have that situation, I'm looking at my risk. The average true range is larger than it was at 9:16 now that we're open. With larger risk comes larger reward potential. I deploy my Fibonacci, modified Fibonacci, and now I'm watching to progress through the trade. I'm entering on the close of the candle. It moves 100% of what I was willing to risk in my favor. And so now my stop, which was here, gets moved to break even. It then moves 150% in my direction, which means my trail stop comes down to 100%. Then it moves all the way and touches 200%. My trail stop was at 150. If it touches 200% for me, I move it within a tick of, I trail it all the way down to just above there. So I don't allow any of that trade to come back when it's touching my target. So I'm entering here and I'm exiting here. That's a $50 move, about $1,000 per contract we would have taken in the room if I wasn't teaching the theory. Now, the next signal comes. It is an aggressive counter trend trade. We'll pull my arrow away here. I got to put that back before I forget. Right here. And we'll just make sure it was. Now, at 9:46, this is an aggressive counter trend trade. ACT. Aggressive counter trend trade, it's a buy signal in a downtrend. We know that those are reversals, pivots about 20 to 30% of the time. And so now I look left for structure. Is there something that's more helpful than this stop right here? I don't want to use this. This is for trend stops only. And so sure enough, if I look left, There's a candle here that formed a low before we pulled up and came back. That is my risk right here. And so at this point, I enter and it immediately hits my stop. Aggressive counter trend trade. I'm out. So let's log that as well. -6.5. -6.5. All right. Now, inside of that environment, I want to come back and look at it through the fourth lens of a CDOS. So I'm going to open up a new chart. New chart. NQ. 1 minute. Same settings for everything. Now, over here, we deploy the fourth rogue isolated method, CDOS. Close in the direction of the signal. So I'm going to put some lines here. These are the lines of the timing signals that we were waiting for. 916, 931, 937, 946, 957. And so at 916, that candle has closed already in the direction of the signal. 916 was a sell signal. The candle closed low. I have my chart set to turn blue when the candle closes low. This is a CDOS. I will turn my red arrow into a blue arrow to help us remember that was a CDOS. So per what we discussed earlier, I can put my stop right above that candle. And now my entry is the close of that candle. If I have a close in the direction of the signal, I can now start to deploy the risk reward structure that we talked about a moment ago, looking for a 1-to-1 or a 2-to-1 RR. In this instance, we get to our 1-to-1 RR, and we would at the very least be break even on that trade right here. That is a CDOS. Let's go ahead and write that, CIDOS. When we were kids growing up, we would have mother-son dances and father-daughter dances, and they were square dances. And I very much remember the do-si-do. Have you ever heard that expression, the do-si-do? Do-si-do was something that they did at these dances. That's how I remember CDOS, do-si-do. At 9:31, the candle closes down. It's a blue candle with a white signal. At 9:32, the candle closes down. It's a blue signal. At 9:33, the candle closes down. Who are we waiting for? We're waiting for the buyers. And the very next candle, the buyers sit on the seesaw and exert enough power to close higher than they started at the open of the 1 minute candle. And so now this is a close in the direction of the signal. My risk is below that candle, 100%. My target is at least 100% of that, or being done by the next signal. 9:37 comes. I only had a few minutes for this to work. And so now I'm entering and I'm in this trade, and I have to be out by 9:37. That selling signal exists because there is a repeating behavior pattern. 9:37 closes, and it is a CDOS. It is a close in the direction of the signal. It is a close in the direction of the signal. And so, same thing. Where's my risk? It's above that candle. 100% of that risk would be here. 200% of that risk would be here. Okay? So let's, for example, assume a trend trading system now and keep track of these things. Enter hits 100% of our risk, gets taken out at break even. Enter, exit by the next sell signal, wait. 9:37, enter, 200% in our direction, 21. Remember, this is a live chart. 9:46 comes, no. 9:47 comes, yes. The candle closes in the direction of the signal. It is an aggressive counter trend trade. This signal is not a winner. It comes and immediately hits the stop on the very next candle. Sorry, 2 candles later, we give up 31. The very next white close candle to the right is the next CDOS in a possible sequence. A close in the direction of the signal with a 1-to-1 RR. Our risk goes below that candle right here. And now I'm looking to exit if it hits 100% of my risk, which it does. Enter, exit, I get 23 of that back. Now, at 9:57, the first CDOS fails. Let's get our box. There's the high of the candle, there's the low of the candle. That's our risk. We're looking for 2-to-1. Let's see how that plays out. That's 100% of my risk. It hits 100. Let's see if it gets to 200. It gets to 150% of my risk. So I have to lock in 100% of the trade, which is here. And now I get $7 out of that signal. So again, the candle closes in the direction of the signal. I'm looking for a 2-to-1 RR, very small because the candle was small. It gets to 150, almost 200, which means I have to lock in 100 here. And now we're done and we're waiting. So one method requires simple closes above the moving average, below the moving average, punctures. One method says, let's wait until we see a bare minimum of movement in our favor. Plus, this is break even, 10, 20, 40, minus 30 is plus 10, plus 7, plus 17 on the morning. Following the CDOS method, which again sort of stands apart from the others. And now using the same method here with the 1-to-1 1.0 ATR, we had plus 17, plus 50, and right now we're in an active open trade. At the close of the candle, we're now plus 7 coming into 10:04. This is a signal with trend right here. When we have a signal with trend, we can deploy a 2-to-1 RR. We have not hit 100% of our risk yet. 150%, I like to draw it in by hand. It keeps me active in my market, is here. So if I hit 25, 199.50, I go to break even. If I get to 10.04, I get out of the trade. Open of the 10.04 candle, I'm out. I don't want to play anymore. There's a white dot. Right here, I'm done. That's a $5 move in my direction. In system number 1, I now have structure to the left of me to reference with regards to 10.04, which is historically a buy time. If I look left, there is structure right here that I can reference for a 1-to-1 RR. If I'm looking at system number 2, I'm noticing that that candle is starting to close above the moving average, above the open, which would make it a CDOS. Two different methods right here in terms of risk mitigation. Right now, my stop is going to be at 10.75. Over here, it will be just below this candle. So now with the CDOS, my stop is here. Now with the aggressive counter trend, my stop is here. Two different methods. 100% of my risk gets me to here. 100% of my risk with the CDOS gets me to there. Two completely different methods. Can an ACT be a CDOS? Yes. We're demanding one level of confirmation more on the right-hand side. This makes sense to some people. You'll later go on to deploy other tools like the rapid fire, I'm sorry, not the rapid fire, the Firefly tool or the PVT tool, other ways to confirm whether or not buyers have arrived. This is a very simple way because the candles either close higher or lower. If I get to break even, or if I get to halfway, this is an actionable item. So here I've gotten halfway to my target. I go to break even. Here I've gotten halfway to my target. I go to break even. Target filled on the close in the direction of the signal. Target touched here, which is freaking annoying, but it is what it is. Two different methods. Close in the direction of the signal at 10.04. Aggressive counter trend trade at 10.04. We'll see if it can make it all the way through. I don't have a provision for this other than to let it go. Break even is the only rule I have halfway. So if it touches me and doesn't fill me, my rules don't have something that says with this trade that I can get out at the moment. I'd be improvising and doing myself and you a disservice because I didn't mention that rule when we started. Target filled on the aggressive counter trend trade, and so we come in now and we mark that $16. Over here with the CDOS trade, enter exit plus 10 basically. So in this case, we let structure determine the risk. In this case, we let the structure of the candle or the architecture of the candle, the open, high, low, close, determine. So as of this morning, from 9:16 until now, 18, 68, 73 plus 83, 89, almost $90 to the high side, -6, call it -10. Let's call that plus 80 on the day, or $1,600 per contract with the NASDAQ, hypothetically, with those trend signals, punctures, aggressive counter trend, as well as crossovers. If we just use the CDOS method, it's a little muted, 11, 31, 41, 44, let's call this 50, 60 minus 30, you're plus 30 with the CDOS, about $600. So a little more risk for the chart on the left, a little less risk, but more confirmation for the chart on the right. We've got another signal coming at 10:13. And same thing over here, 10:13. I'm going to take a restroom break. I'm going to literally run or walk quickly. I'll be right back. Okay, I'm back. I'm back. Now at 10:13, we have a stop of our signal with trend. Our stop of a signal with trend is usually emblematic of a trend reversal. So in this instance, the close of the candle was here. The stop is there, and we give $21 back. We can, if we're trend traders, notice that when this occurs, that it can be a signal of an overall trend reversal. So if you're a swing trader, noticing that this has happened here can be a way of evaluating that, in fact, a time where sellers were supposed to arrive, they did not. And so in theory, one could place a long signal here with a stop below the low. Where is it? If you're a swing trader. Where did I put it? Account. I thought I had it. It's not showing up. So if you hit the stop level of a signal with trend, it can be a very strong indication that the trend has reversed. If the trend has reversed, you can now use that level as a 2-to-1 RR. Otherwise, we have nothing to do on this chart until 10:38. If it closes above the moving average and then closes back below the moving average, we can trade a crossover trade. On this chart, we were looking for a CDOS. We had the one at 10:04 that we traded right here. That we took 10 from. Then at 10:13, it was a high close candle, so no. At 10:14, it was a high close candle, so no. 10:16, it was a high close candle, so no. 10:17, it was finally a low close candle, or a CDOS. So we'll come grab our text for that. Now the risk on that trade was very small. Let me put this right there. In that example, the close of the candle was here. And the risk on that candle was there. You see how small it is? In that instance, I'm looking for a reason to have more risk, because in this instance, you can see the most we stand to gain on that trade is only $2 or 8 ticks. It's $5 a tick, so that's a $40 trade. But keep it simple, we'll basically just say we lost $2 on that move. If we have a low close candle between now and 10:38, that will be another CDOS. It'll be against the trend, but it'll still be a close in the direction of the signal. Sim Facebook. Here we go. So if you were a swing trader right now, your stop would be below the low. You've seen a puncture of the blue line telling us there are no sellers here. The sellers had a chance at 1013. Nobody showed up to the party. It must be all buyers. And if we're swing trading this, we can look for a high side 2-to-1 RR trend signal, target at around 354 or so. So punctures against us, punctures against the trend, can be a signal of trend reversal. Okay, so we'll leave that in a separate sim account. And right now we don't have anything to do until 1038 over here, or unless a candle closes below the moving average, which will be a crossover trade in the 4 basic rules of our system. In 44 seconds now, we're looking at a potential CDOS, a close in the direction of the 1013 sell signal. And all of these things that I'm showing you and telling you apply to Chronos as well. Everything we're doing in Warp, we can do in Chronos as well. Okay, you have your close in the direction over here. On this guy, we have a close in the direction of the signal. Your stop is going to go 2 ticks above the candle. Right there for your CDOS. On this guy, this is a crossover trade, so a 2-to-1 RR. Our stop is in the same spot. Our target is 2-to-1 down below. Right here with the CDOS, it is also a close in the direction of the signal. We're looking for a 2-to-1 RR on it as well. Okay, so that's 1-to-1 RR. I'm just going to go to break even on these. Break even for me would be at the original entry point, 150%. I lock in 100. I lock in 100. Now I'm in my 150 to 200, so I can close this in my no judgment zone, or I can let it continue. So 150% on this trade would be here, and you could see I made it to that mark and past that mark. So we can exit here or deploy discretion and say I'm going to just let it see if it goes there. And either way, we ended up in profit on that trade. So the CDOS here eventually hit 100% for a $21 move in our direction. The crossover trade we talked about at the open. Got to our 150% mark and we took the money. So from here to here would have been 100%. I got into that no judgment zone and said, let's get out at $32. There's now nothing left for me to do until 1038. There's nothing for me to do here now until 1038. So let's mute the mic and wait. Hello, I went over all of those things when the class opened at 9 o'clock. You can go back and watch the recording at the end of the week. I discussed what a CDOS, an ACT, a crossover, and a CDOS were at the beginning of the class when we started. Next time, try to get here when we start. I covered all of it. And so tomorrow we'll be doing lessons number 2 and 3 as well. So I start at 9 a.m. and that'll be covered in the recording, as well as in the book that I'm going to give everybody at the close on Thursday. Yep. So we went through all of that here today. Everything that we talked about is what we've been looking at live here so far. No worries. Okay, we're getting closer to 10:38. So one of the things I like to do is prep for that. And I'll put a vertical line on both of those to just bear in mind what I'm looking for to have happen. Again, the last setup we looked at was the close in the direction of the signal. And so we'll go ahead and take the risk reward architecture down over there. We had the crossover, and now we're watching for 1038 to occur. It'll be an aggressive counter trend when we first get there, and then possibly a puncture if it continues to go down. 1038, we'll be looking for a high close. Recordings are in the customer lounge. When you log into the website under your username and password, there's an area for room recordings that are populated, I believe, at the end of the week. If someone can confirm that. Coming up on 10:38, we've got 1 minute and 5 seconds to see if we're going to have an aggressive counter trend trade, what the risk on that will be, as well as close in the direction of the signal. Now here, 52 seconds to go. One of the things I can start to do is just keep track of where my risk is. And so right now the low of the candle is right there. And so that's something I can keep track of. Over here, the structure is way underneath. So we'll be referencing the low of the candle here. So in these instances, the aggressive counter trend trade and the CDOS trade are both the same risk. So we'll see what that turns into in 10 seconds. So in this instance, our risk is right underneath this candle. Put it at 43 for each of those. Once I have that, I'm looking for a 1-to-1 RR. No guarantee either of these trades will work. We're looking at statistics and probabilities as opposed to certainties. The time is what drives this. This is a time historically where moves typically go higher. Tomorrow, we'll learn that this was a pattern 9, and we can treat it like a pattern 5. Pattern 9 out of your histogram guidebook, but you wouldn't know that at this stage in your day 1 to week 4 to week 6 envelope. So for now, we're just assuming this is a 1. We don't know this is a 9, and we're trading it accordingly. On this side, we have the opportunity for a puncture if it continues to go down and blow through the stop line of the white dot. So right now we're looking to see if it'll go 100% of our risk in our direction. But if it fails and continues to come down through the white line, we can trade it as a puncture. If it hits the stop here, we'll look for another high close candle between 1038 and 1047 to take another swing at bat. While we're waiting, I'll come here and I'll draw a line halfway. Again, I think drawing is very important. When I get halfway to my target, I move to break even with a 1-to-1 RR. So now we have a trade where we can't lose. I lock in 1 tick. Same thing over here, 1 tick. So I'm taking out on our aggressive counter trend trade. Nowhere to go. So we're done here. There is another CDOS right here. We'll blow this up. 1038 was a buy signal. It was a CDOS. And we just got taken out on our break even play. So if we have another high closed candle, that's another opportunity. If we have a close above the moving average before 1047, that will be a crossover trade. In the meantime, the only possibility on the left side is a puncture down below. No close in the direction of the signal. Here, low close candle, so we wait. That one happened too fast, but I have to document it. I had my head turned. This was a CDOS. It closed above. It came and hit the stop. That would be a -6 right here. It was also a crossover trade. It happened too quick. I could have gotten my stop in, but we'll count this one as well. This is a crossover trade. It came below and hit the stop, -7. So I'll put a note here to remember, and I'll pay closer attention next time. Next signal coming up is 1047. All right, to get ready, I'll just move my vertical line over here to remember 1047 is coming, so I'm not caught unawares. The puncture still exists. We'll go ahead and get rid of the prior stuff on the screen that might mess me up. The puncture is possible all the way until the close of the 1047 candle. All right, 37 seconds. If this candle closes high, it won't be a CETOS. On the left-hand side of the chart, we don't care. It's going to be a signal with trend. Level 4 students, please note the polarity reversal at the last three signals. Up at 1013, down at 1038. Expect an up move at 1047. All right, stop above the blue dotted stop line. No CETOS here at 1047. We're looking for a 2-to-1 RR following our money management rules. We'll squeeze this out to exactly where our entry would be. We're looking for 100% to go to break even, 150% to lock in 100% of our move, and then targeting anywhere between 150 and 200%. This is a signal with trend. No CETOS yet on 1047, high close at 1048. Again, level 4 students notice the move up at 1047 and not down. We'll talk more about that on Thursday. Stop filled, all flat on the signal with trend. This is another example of the blue line getting hit from below. We can reference structure here. That last swing trade didn't work out. And so if we were looking for another failure of a trend signal as a reversal, we could do that as well. But again, level 4 students, we're going to talk more about this on Thursday. Notice how it went up at 1013, it went down at 1038, and pursuant to what I said a moment ago, went up at 1047. So that's another phase that you're eventually going to get through and start to learn about. Yeah, showing the two charts side by side is a great way to sort of help you understand which way aligns more with your center of gravity. So if you like the one and not the other, you're not really sure until you see them side by side. So I want this to be a video that people can reference per the book and see a live demonstration of those signals. No CDOS, no CDOS, no CDOS, no CDOS, 9 seconds to go. Still on the edge. 5, 4, 3, 2, 1. CDOS. Stop above the candle. Looking for a 1-to-1 RR. 2-to-1 if we want to go for trend. Womp womp. So CDOS here, stop hit. And guess what? That's going to happen. That's why risk mitigation is so important. And we don't want to bet the farm on every trade, because pretty soon there's no farm if you do that. No CDOS. 1040, 1054 is coming next. Trigger candle right here, level 4, close above emerging trend line. $10.54 coming on the NQ. We'll be looking for a high close candle for a CDOS. 10.54 coming on the NQ. We'll be looking for a signal with trend until 11:06. $20 seconds to go. Again, we need a high close candle for the chart on the right. We need no such thing for the chart on the left. Stop below the white line, signal with trend. Stop below the low of the candle, 2 ticks. CDOS. 2-to-1 RR, chart on the left. Target 319. This guy will go for a 1-to-1 RR. Break even. Target at 100%. Break even taken out, chart on the right. Got a ways to go for the chart on the left. But we will, for the record, note the CDOS over here as we wrap up this morning. Let's just take a look at all of these together. And we'll take note of our break even right here. And this is the net result of the signals in the direction of the trend this morning since we've been following that. Net positive day for sure. Here we are, we're up $16, about $300 so far, $400 almost. And to get to break even, we need to go to 297 even. We're still just shy of that. We got to 95, 75. I need to get to 97. So we're 5 ticks away from there right now. Let's see what they do. Remember, we have until 11:06 for this guy. Let's go. Come on, make a decision. I need to get to here. My stop is here. My entry is the close of this candle. 150% is here. And 200% is right there. Retest of the high, 95.75. All right, we get to go to break even. Plus, on our signal with trend, remember when we started, that was one of the very first that we were looking for. Right here, signal with trend crossover. So we can hold this now until the next sell signal, or we can do like we're doing now, deploy our risk management architecture, get to 100%, go to break even, get to 150%, lock in 100%. Anywhere from 150 to 200% is the no judgment zone. Ideally, we want to try to get to 2 to 1, but if there's anything that causes you to stir internally and say, I want Audi 5000, you can get out 150 to 200. We don't have that luxury afforded yet. That doesn't happen for us up until around 308, 308.50. Some people choose to trail below the low of each candle. So you could have a trail stop underneath the low of each of these candles as they form. And that's a very satisfactory, time-tested trail stop approach as well. So you're basically following up under the low of each of these candles. We don't have a provision for that in our rules though, and we're waiting for several things to happen. Number one, it can hit 150, at which point I lock in 100. Number two, it can hit my trail stop and take me out. Number three, it can go all the way to 200% and take me out target-wise. Number four, at the 11:06 signal, I exit. There's literally nothing else for me to do or think about. The voices in my head, no fertile ground to plant seeds in. And your trading plan should endeavor to fill the pockets that your mind fills with that noise. Well, maybe we could do this, or maybe we should do that. I trade as though there's a version of myself who walks in this door right now at 11 o'clock and says, show me what you did today. And if I improvised or violated any of the rules, I get fired. He pays me to trade the system that he taught me. And all the rules I've taught you so far are the rules that I follow in the class each week when I'm doing it. And if there's any variation of that, or if I don't have a provision for that, I have to leave it alone. And so if my boss comes back at 11 o'clock and sees that it didn't hit 150 and came back and hit the trail stop, I don't get fired because it was his rule. It's a little crazy, a little dissociative, but other than that, I'm employing discretion, I'm employing improvisation, and these things I have found are relatively deadly to my account. They are to be avoided at all costs. I would rather take a stop or a break even than a winner where I used improvisation in the moment, because inevitably what happens, it does go to your target twice as much as you took out. And now you have the shame of that, which starts the shame cycle. You start making more errors. It's just a mess. All right, break even taken out. I can live with that. And we're going to stop here for the day. Phase 1, December 25 is the same as 12/25. There are 12 months in the year. December is month 12, so it's just a different way for it to show up on the screen. It's the December contract, so whether that's a 1-2 or a DEC, they mean the same thing. Guys, I'll see you tomorrow morning. We're going to start fresh, 9 o'clock, bright and early. We'll cover phase 2 of our learning and phase 3. We're going to mix those two together. So if you're just using the software, these are the rules we want to be watching for and adopting. As you get into weeks 6 to 8, you're going to start to notice the things that we're going to cover tomorrow, phase 2 and phase 3 of learning. So try to get here when we start, and we'll get that recording in play. By the end of Thursday, we'll have covered everything I know to watch for, and I'll have your book ready for you, as well as these videos having been recorded for you to follow along with. Take care. Have a great day.